Great. Thank you for joining us today, everyone. My name is Carrie Leoge, and I am the Skills Development Officer here at Women's Enterprise Center. I work out of our Kelowna head office. Thank you for joining me on this session today. And quickly, I'll just give you an overview of what will be taking place. We'll do a quick introduction of Women's Enterprise Center, the services we provide. I will introduce our two panelists today, joining us today on the call. And then we will get started our discussion based on some of the questions submitted when you registered for the discussion today. The Women's Enterprise Center is the leading business resource center for aspiring and established women business owners in British Columbia. We provide loans of up to $150,000, skills training, mentoring, both in a peer group and one-to-one format, business advisory services, and resources from our three offices located in Kelowna, Vancouver, and Victoria. Our passion is to empower women entrepreneurs to their business success. We are a nonprofit organization funded by the federal government through Western Economic Diversification, and we're part of the Women's Enterprise Initiative, which includes similar organizations in Alberta, Saskatchewan, and Manitoba. To stay informed about the services that we offer, what is happening in your local area, please go to wec.ca and sign up for our e-news and e-blasts. So here's a quick webinar 101 for today. Again, just to reiterate, the Q&A on the right-hand side is as we go along. We do have all participants today in listen-only mode to keep the feedback from background noise as quiet as possible. So please, if there's a question that goes unanswered during the discussion today, type it into that Q&A session, and we will take a review of those at the end of our discussion. If you don't see the Q&A box, again, just on that right-hand side, click the little blue arrow, and it will drop that down for you. And then the chat box is the ability to communicate with one person or everyone on the webinar as well. And welcome also to those participants that are joining us by phone today. We also have you on mute, again, to just avoid that background feedback that we've experienced in the past. So to answer your questions about financial literacy this morning, we are thrilled to have joining us Kath Britton, who is a senior business advisor here at Women's Enterprise Center. As the Senior Business Advisor, Kath works directly with women business owners to provide one-on-one complementary business guidance. She reviews and provides feedback on business plans, evaluates loan applications, and provides support to our current loan clients. She has over 10 years of business experience, and after starting her career in engineering and project management, she spent 4 years in the banking industry as a commercial lender and business analyst. She received her MBA from the UBC Sauder School of Business in 2005, her CMA designation in 2008, and has been working with Women's Enterprise Center since 2010. So welcome, Kath. Thank you for joining us today.
Thank
also
you.
On the call, we have Lynn Wong, who is an associate partner with Crowe Mackay here in Kelowna. She has over 18 years of experience providing audit and assurance services to a wide range of sectors, but specializes in professionals, construction, and not-for-profit organizations. Lynn's experience includes financial statement audits, audits of specific elements, accounts, or items of a financial statement, and issuing reports on applying specialized auditing procedures to financial information other than financial statements in a not-for-profit environment. Her background in audit and assurance services provides a level of experience to all of her clients, regardless of what stage their business is in. From startup to long-established businesses, Lynn is able to provide insight in order to assist her clients in their continued growth and success. So everyone join me in thanking Kath and Lynn, thanking them for participating on the call today. And Kath and Lynn, can you hear me okay?
I can hear you, yep.
I can hear you as well.
That's great. That's perfect. So to get us started today, financial literacy, understanding the money side of your business. If you don't understand where you are today, how can you forge the path to grow to get where you want to be? So by understanding how to read and develop those key financial statements, you will have an accurate financial foundation on which to make the decisions that will help you grow your business. So today our goal is to help demystify those statements for you and explain the information that they contain. We want you to be able to make well-informed decisions for your business. So to get us started, we're going to look at the cash flow statement, one of the three main financial statements that you should be reviewing in your business. So Kath, I think we'll get started with you this morning. If you can go over for us what the cash flow statement is, why it's important, and how the business owners should be using it in each of their businesses.
All right, I will do my best. Can you turn it to the next slide, please?
Of course.
Okay, so first I want to explain to you what cash flow is. So basically it's the inflows and the outflows of cash in the business, what money is coming into the business and what money is going out of the business. So it shows your liquidity, or basically your ability to meet short-term cash needs. And a positive cash flow, which is better than a negative cash flow. Positive cash flow means that each month you'll be able to pay your bills, and then you'll be able to cope with anything unexpected that might happen in the business because you'll have positive cash flow. The negative cash flow, on the other hand, is going to start to drain your cash reserves. And if you've got cash in the bank from the previous month, then you're still doing okay. But what happens in a month where you have negative cash flow and you don't have funds in your bank account to back you up? So that's when you're going to start to see a problem. So I'm going to talk a little bit about the sources of cash and the uses of cash in your business. The sources of cash can come from a few different places, as you know. So one of the primary ones is your sales or your revenue, the cash that you collect from your sales, or the cash that you collect from, say, your accounts receivable. Sources of cash can also include your debt. So if you get a loan from the bank, that will be a source of cash. It could be an owner investment, so cash that you invest into your business, or investor financing. If you sell shares in your business, you might get cash. Also, you could sell an asset that you have in your business. So say you've got a piece of equipment in your business and you don't need it anymore, you could sell it and get cash. So those are all sources of cash. In terms of cash outflows, those would be all the expenses that you have for your business that you pay for during the period, so your rent and your utilities. Another source or another use of cash would be your loan payment if you owe the bank money. It could be if you need to purchase equipment or assets. Equipment or assets or inventory. Or an owner withdrawal or paying down shareholder loans is another outflow of cash. So all of these cash inflows and outflows, they're all captured in your cash flow statement. And basically, you can look backwards on your cash flow, and your accountant might do this for you when they do your income statement and your balance sheet. They might prepare a cash flow statement for you as well. But you can also look forward in your cash flow and do a cash flow projection. And this is where I think it's the most particularly important, because it can help you from avoiding issues that might arise in 3 or 6 months ahead in your business. If you had done a cash flow projection, you might have realized that, oh gosh, I'm going to be short of cash come September because I'm predicting a slow season in the summer or something like that. So Women's Enterprise Center actually has a great cash flow projection template. We've got an Excel file. It's basically an Excel file with all the formulas embedded in it, and you can just adapt it to your business. Okay. So now, this slide, I'm going to talk about, I'm going to walk you through an example of a cash flow. So you can just keep it on this slide for a sec. So let's look here at the cash inflows first. So you'll see in January, an owner investment, so 3 lines down, an owner investment of $3,000. And you'll see in February, on the second line, in loan advances, a loan of $6,000. So these are all cash inflows. And you'll also see cash receipts in January, February, and March. January is $1,000, February is $2,000, and March is $1,500. And then we'll see all the cash outflows, so the disbursements. So you'll see that inventory purchases, advertising and promotion, paying your loan. You paid your loan $200 in March. Office supplies, rent and utilities, etc. So your cash inflows minus your cash outflows for the month equals your net cash flow. So you'll notice in March, your net cash flow was actually minus $425, as opposed to the other months, it was positive. And in this case, it's not a big deal because you've got cash in the bank. You can see the cash balance at month start and the cash balance at month end. And so this is just, this could either be looking forward, as I say, or looking backward. It could be a projection or it could be actual historicals. Okay, so now you can stay on this slide still, but I'm going to touch on how you can tell if you have a cash flow problem. So basically, if you can't sleep at night because you're worrying if a check is going to bounce, that's your first clue that you've got a cash flow problem. Also, if you're seeing a negative trend of cash flow management each month, or sorry, cash flow each month, say what happened to this business in March where they had a negative 425 net cash flow. If you keep having that month over month, that's going to erode your bank balance, and you're going to be having cash flow problems. If your receivables are adding up, or if your line of credit is adding up, that's another indication that you're having cash flow problems. And now I'll just touch base, you can stay on this slide, I'll just touch base on a few things that you can do to improve your cash flow. And some of these aren't as comfortable. Oh, I'm just going to turn my volume down a bit. Apparently I'm a little bit loud. Just a sec, guys. Okay, does that make any difference? All right. Basically, there's a few things that you can do to collect and improve, or sorry, to improve your cash flow. One is to collect on your accounts receivable, and it can be a little bit uncomfortable because collecting on your accounts receivable, you know, it might mean calling a customer when their payment is late, or you know, you could perhaps have penalties for late payments. So for those of you that don't have a credit policy, putting a credit policy in place is really a good idea. And then sticking to that credit policy, because there's no point in putting together a policy if you're not going to take action on things like calling your customers, etc. Another way to improve your cash flow could be payment of accounts payable. So you could stretch your payments until they're due, but not stretch them until they're overdue. Make your payment on time, but just not pay them in advance. You could also look at your inventory management. Are you carrying too much inventory? Can you sell off some of your inventory? And then you could also consider leasing instead of buying assets. So that will tie up less cash in the business if you're leasing your asset instead of just, you know, spending $10,000 to buy a piece of equipment. All right, next slide. All right, we'll send it back to you, Carrie Lee. Oh, actually, no, I'm sorry. I'll keep going. I'm going to talk about the income statement now, so you can go on to the next slide, okay? So the income statement basically shows how well your company has done over a certain period. So this could be monthly, it could be quarterly, it could be on an annual basis. And this is important, and it's especially important for seasonal businesses. So say you own a bike rental shop. Chances are, in the summer months, your revenues are going to be much higher than in the winter months. And likewise, your fixed expenses could be the same throughout the whole year. So you could be having a loss in some months and a profit in other months. It's kind of like a report card for your business. Okay, next slide. Okay, I'm going to walk through the income statement categories now. So sales or revenue, these words are used interchangeably, but revenue is basically the money that you earn from selling your product or service. And when you earn the money isn't when you actually receive the money. And I'm going to give you an example of this. So say you sell juice products to Whole Foods. You might sell them to Whole Foods, but they might not pay you for 30 days. So you would record that revenue when you sell them and you give them the product. You record it as revenue, but you're not actually getting the cash in until next month. So that's one of the differences between, say, an income statement and a cash flow statement. Okay, next item is the cost of goods sold or cost of sales. And this is the cost that's directly associated with the product or the service that you're selling. So it's not the inventory that you're buying, but it's rather what you're actually selling, the cost of what you're actually selling. And a lot of people ask, okay, well, what about labor? How does that come into play? So in manufacturing, if you have a manufacturing business, your cost of goods sold is going to include all your product costs, and it's also going to include your direct labor, so the wages and the benefits for the people that are actually making the product. But if you own a retail store, a clothing store, say, your cost of goods sold doesn't include labor. The labor there would be included in your expenses or in your overhead. And then in a service-based business, your labor is really on a case-by-case basis. Okay, and then the next line item is the operating expenses or overhead. And some people might call this the SG&A or the selling general and administrative expenses. And all these terms are used interchangeably as well. And these are all the expenses that don't relate directly to the products or services that are being produced. So it's often your fixed expenses, things that don't change like your rent and your utilities, and it's other items as well like your advertising, your supplies, your depreciation, that sort of thing. And then the net profit or your net loss, this is your bottom line. So it's the profit that your business has made after subtracting the cost of goods sold and subtracting the expenses as well. And if it's positive, then you have a net profit. And if it's negative, then you're going to have a net loss. All right. Next slide, please. Okay, so now I'm going to walk you through a sample income statement for a company. So you'll see, and this could be for a month, it could be for a quarter, it could be for a year. It's just whatever that period is that they're trying to capture. So let's call this an income statement for a month. So in the month, it says here for the year ended December 31st. So this is for the whole year. The revenue for the whole year was $45,000. Their costs of goods sold was $12,500. So that's not how much they purchased during the year, but that's how much they sold during the year. And their gross margin was $32,500. And you can get your gross profit margin, which is a really good metric to keep in mind. And you get your gross profit margin by taking your gross margin and dividing it by your revenue. So in this case, it would be $32,500 divided by $45,000. And then you'll see all your expenses, so your wages, your rent, your utilities, your supplies, and then we have also your depreciation. And I wanted to just touch on this depreciation. So the depreciation, this isn't a cash expense that's come out. I'll give you an example of depreciation. So say you buy a piece of, say you're selling these juices to Whole Foods, and you buy a labeling equipment, and the labeling equipment costs $5,000. But you know you're going to use it over, say, a 10-year period. So while your cash flow is $5,000 out the door because you've paid for it, your actual income statement only shows a portion of that because you're going to be using it over, say, 5 or 10-year period. So you don't put all $5,000 in your depreciation or in your operating expenses. You just put a small portion of it, and then in the following year you'll put another portion of it. Make sense? Okay, now I'm going to talk just a little bit about the differences between cash flow and income statement. So you could have amazing revenue, your business could be growing, and you've even got good profits on your income statement, but you still don't have any cash. Or vice versa, you could have a large cash balance, but you didn't make a big profit. So here are some things. So taking this example here, one reason why so they have a net income of $75.50, and so that's a net profit. But if they had purchased a piece of equipment for $10,000, they would actually have a negative cash flow because they've used more than that 70. Well, they could have a negative cash flow because more money is going out than is coming in. And there are other reasons why that a cash flow might be different from an income statement. So, say, have you ever noticed that in an income statement you show one of your expenses is interest expenses, but if you have a loan payment that you're making, you make that whole loan payment. So, say your loan payment each month is $3,000. That's your principal and interest of your payment. In the income statement, you're only showing the interest portion. You're not showing the principal, the payment in principal. The payment in principal is actually captured on the balance sheet, which Lynn's going to be talking about. And then likewise, other reasons why your cash flow might be different from your income statement, things like inventory purchases. So say you run a clothing store and you do your, you do 3 seasons of purchases, and you go to LA every 3 or 4 months and you spend $50,000. Well, the $50,000 that you spend in cash is not going to show up on it'll show up on your cash flow statement, but it's not going to show up on your income statement until you actually sell the retail goods, until you actually sell the clothes. Then it's going to show up on your income statement. All right. So next slide. I think we're over to Lynn now with the balance sheet.
Yes, thank you, Kath. That was great. Just a note to everyone that in the chat, I have put a couple of links to the templates that we have for the cash flow statement and your income statement and balance sheet, and we will also share some links to those resources in an email following this event as well. So moving forward, we've taken an overview of our cash flow statement. We've reviewed the income statement, and now the last piece of that pie that you see there is our balance sheet. So Lynn, handing it over to you now, this is another important statement for many reasons. Can you tell us who uses this statement, what it says about a business, and why we should be paying attention to it on a regular basis?
Absolutely. This is a really, really important tool because it looks at the overall health of your business. I don't think that any one piece can be looked at in solidarity, and we need to break them all down, and then they do all actually tie together. So while the income statement looks at your operations for a specific period of time, generally a year-by-year basis, you definitely look at it, month by month, but it is accumulation of transactions for a specific period of time. The balance sheet actually is a snapshot of your financial position at a certain date, and it really looks at everything that you own, which is your assets, everything that you owe, which is your liabilities, and then the difference is your equity. And so you can just forward to the actual balance sheet in the slide. Thank you. In a for-profit business, the balance sheet is called a balance sheet, but I actually like the not-for-profit term for the balance sheet, which is your statement of financial position. So you won't hear that when you're with your accountant or with your banker if you're a for-profit business, but I think it actually is an opportunity to use a different term to explain what it is. So it is your financial position, and you can see there's 2 sides to it. So there's the assets, and then there's the liabilities. And the accountant in me loves that this balance sheet balances because all balance sheets should balance. And so the total assets equal the total liabilities and owner's equity. So looking at the left-hand side of the page, which is the asset side, there's current assets, and then we have a separate section for long-term assets. Liabilities are also broken down that way, and I'll discuss that a little more. But current assets are essentially your assets that are liquid, that you have access to immediately or within the next year. And so, you know, inventory, accounts receivable, obviously cash is king. You have access to that at all times. Your receivables, you should be collecting in a timely basis. I say should be, but we all know that that can be difficult at times, just as I'm sure, you know, you have cash flow issues in your businesses at certain times, so do the people that are buying from you. And so, but that is what you expect to receive in the next fiscal year, as well inventory that you expect to discharge and therefore sell in the next year. There's also a line item here for marketable securities. So if you have an excess of cash, it is best if you don't need it in the business on a day-to-day basis, to have it in some type of an investment that can have that cash earning money for you within your business, but also is accessible to you should you need it. So that's the current assets. The next is the long-term assets. Here on this balance sheet is property, plant, and equipment. Essentially, you'll sometimes hear the term a fixed asset, capital asset, property, plant, and equipment, but essentially it is assets that have a lasting value, that are tangible, and that are used in the business. The intention is to help produce profit and generate future investments. So the example that Kath used was, you know, if you're selling juice to Whole Foods and you buy a labeling equipment, that labeling equipment has lasting value. That is where you would allocate that type of asset. It's used in the business to generate the product that will then be sold, that will help you to produce profit, which will then allow you to be able to invest in either further assets, growth, increase your wage, hire new employees, all of those opportunities. So that's a breakdown of the asset side. Now the liability side, on the right-hand side of the screen, is there's current liabilities. Essentially, those are your debts that are due within the next fiscal year. Often your accounts payable, so your vendors, your current income tax debt, which could be GST, it can be payroll taxes, and also your corporate taxes, and then any wages payable. And while you pay your employees, we have to look at this as a cutoff date. This is a snapshot at a period of time. So in this case, the balance sheet is at December 31st, 2016. While your employees have earned their wages up until December 31st, maybe you pay them the following week. So you need to reflect that there is a liability out there and you just haven't paid it yet. And that's why that point in time concept is very important. It's important that the statements reflect the transactions that occurred during the fiscal period and at that point in time, so that you can give the reader a true picture of the financial position of your company. The next section is long-term liabilities. That would be items such as loans payable or notes payable. So if you have a loan with Women's Enterprise Center, the principal of that loan would be allocated to that section. Now, loans are actually broken out into two sections of the balance sheet. And it really is when they're due, and it's based on the terms of the loan. But if you have a loan that is a 5-year term, it's not callable, we actually would put 4 years of the loan into the loans payable line item, and then actually up in the current liabilities would put the current portion of that long-term debt, which is the debt that is due in the next year. And again, that gives the reader or user of the financial statements a really solid idea of the requirements at that point of time in the next year for that business and the cash flow needs. The next section is, or I'll go back to the loan, sorry. So if there's 4 years left on the loan, then the loan payable line item would be 3 years of principal, and then the current 12 months again would be up in current liabilities and so on. Also, if you have leases that are treated as, there's different types of leases, but as a capital lease, again, that debt would be reflected there as well, the long-term portion. The next section is owner's equity, and I'm not really going to get too much into this area of the balance sheet, but essentially it's what ties it all together. It's the cumulative effect of the operations from the inception of your business, which then tie in where you are today. So, for example, you have your income statement, which shows your net income year over year over year. That balance, that statement starts brand new every year. You get a clean slate. But what happens with that profit, because that profit relates to cash, and so hopefully cash or accounts receivable, or you've used that profit to purchase more inventory. All of those items I just mentioned are on the balance sheet. And so how do we get then the net income or the results of each year to show on the balance sheet? And that's where this information goes. And it essentially is the income that you have been able to retain in the company since its inception, which allows you to have a balanced statement of financial position or balance sheet. So that's kind of an overview of what the balance sheet is, but I just want to touch on a couple of items that are really important, I think, when looking at the balance sheet. And you know what, numbers are numbers, and we can't often, you know, as an accountant, I'm looking at the numbers afterwards. And I'm not going to change them necessarily unless something is accounted for improperly. But what I do want to know is the story behind those numbers so that we can help you and advise and maybe look at different strategies to improve your balance sheet. And so one of the items that we would look at, or your lender maybe would look at, it would be working capital. And so what is working capital? It's essentially your capital assets, your current assets minus your current liabilities. And essentially that's the capital of the business that's used in day-to-day operations. You can see there's cash, accounts receivable, you'll be collecting those regularly. Inventory, you'll be buying and discharging regularly. Accounts payable, again, you'll be paying on a regular basis. And so it really talks about the story is does the company have enough short-term assets to cover its short-term debt? And if it does, that's fantastic. And it's really just an indicator of short-term health. It's an indicator of efficiency. So are you collecting your receivables in a timely manner? If your receivables are out, you know, for 60, 90, 120 days, well, then there's a few things that you need to look at. You need to look at, as Kath mentioned earlier, your credit granting policies. Are you extending credit to individuals and companies that essentially don't deserve it? If they aren't paying for the goods that they've received from you, then that means essentially you're funding them, and you aren't a bank. And so, you know, are you collecting? Are you turning over your inventory? What happens when you turn over your inventory is that it's because you're selling. So therefore, you can buy more inventory and sell more. And that is absolutely an indicator of growth, and as well an indicator with inventory turnover of whether you have the right mix. There's a lot of stories that can go along with the results of looking at the balance sheet at a specific certain point in time. Now, if you have a negative working capital, meaning that your current assets are less than your current liabilities, then that means obviously, well, you have negative working capital, and there could be some red flags that would go up. I mean, worst case scenario is bankruptcy, but you know, maybe it just means you have some cash flow issues and you need to look at your policies for collection or you know, that you need to inject more inventory so you can sell more. The other is sometimes having too big of a current asset, meaning that your current assets are significantly greater than your current liabilities. That actually is not a good thing either, potentially, depending the makeup of your current assets. So maybe you have too much inventory. That is cash that you've spent on a product in order to resell it, and now it's sitting there. That can be very detrimental to your business. So it's you know, or you have excess cash and it's as well sitting there, and you could be doing something else with that. Those really are the main items with regard to the balance sheet that I wanted to mention. The other item, if I could just take a moment, is to indicate that the balance sheet is essentially historical cost, and it is not fair value. And so when you look at, for example, property, plant, and equipment, on this balance sheet, it's $85,000, $85,700. As Cass mentioned earlier, there is depreciation. So this is actually the original cost of the sum of all the capital assets that were purchased, less depreciation. So if there was a building in there, and say you purchased the land and building for $150,000, and you depreciate, land doesn't depreciate, but the building depreciates over time, we all know land and building values go up. So maybe you've depreciated that land and building down to $85,000. However, the fair value of that land and building could be $400,000 at this point in time. This balance sheet does not reflect any inherent gains that are within the assets. All that it shows is the actual cost, depreciated cost of that asset. And the gains, once they're realized, will be recorded when and as that happens. I think that's just an important note to make. That was everything I wanted to kind of bring forward about the balance sheet, but obviously happy to answer any questions that come my way. I'll turn it over to you, Carrie Lee.
That's great. Thank you, Lynn. We do have some questions coming in. That's great. Thank you, everyone. So again, just a reminder, you can click on that Q&A on the right-hand side of your screen and type your questions in there. We have one question here. Kath is going to answer. It says, what if the debt is to the owner? The business has a positive cash flow, but not enough to pay back the loan the business owner gave when starting. Do we show that in the balance sheet?
So the answer is yes. You would show that in the balance sheet, and that would be under shareholder loan, under your long-term liabilities. So it would be a loan pay. So here we have a loans payable of $40,000. It could also be a shareholder loan of, say, you put $100,000 in the business, a shareholder loan of $100,000. And what's interesting about this is that lenders, when they look at this, they won't see it as a liability. They will see it as an equity investment. So they'll take it out of your long-term liabilities, and they'll consider it often as to be part of your equity. Say you did originally start the business with $100,000. You loaned the business $100,000. If you, and Lynn, you can correct me on this, but if you pay back $10,000 of it to yourself, so that you only owe $90,000, or so that the business only owes you $90,000 now, You'll then show $90,000 on your long-term liabilities as a shareholder loan. Your cash flow would go down by $10,000 because you've paid $10,000 in cash. And will it hit your income statement? I don't believe it will hit your income statement, will it, Lynn?
No, it will not. It will not hit your income statement. It's actually just a balance sheet transaction in that you reduce your cash and then you reduce the debt or the equity to you. Also of note with regard to repayment of shareholder loan is that it does not have to be reported on your personal income tax return as income because essentially the concept is that you've earned that money somewhere else and paid tax on that money in order to be able to invest it into your company. And so any funds that you withdraw from your company that are applied to that shareholder loan are withdrawn on a tax-free basis because they're already tax-paid dollars.
Okay, perfect. That's great. I'm just going to switch now here back to our sample income statement for the next question. So this one came in. If you have a service business and your labor costs are contractors brought in on specific projects, do wages go into your cost of goods sold?
I think this is a perfect question for Lynn.
You bet. This is I hate to say it, but it depends. And so it really depends on your business, the type of business, and the value that the result of putting those costs in cost of sales will give you as far as a measurement tool. So these financial statements really are a management tool in order for you to make decisions. And if you can see that on a project, if you are accounting for your transactions by a project, you can say, look, I didn't have time or the expertise to do a certain portion of the project, and therefore I had to subcontract, and that was a direct cost of that project, and therefore that project didn't generate any profit for me, then that is an important tool. And so you would want to put it as a cost of goods sold because it directly applies to a specific either project or transaction. If you have subcontractors that do many different things for you, many different projects, and then you may not even use a cost of sales approach. You would just have revenue and then your operating expenses, and all of those wages would go down there. Now, on the other hand, I would say I would still allocate subcontract fees that you pay separately from wages because they are a very different animal from a tax perspective.
Okay, great. And then another question related to the income statement. Where would travel and entertainment costs related to sales development sit? And it says here this is for a services business, but I think it would be the same regardless, but I'll let you speak to that.
So any travel or entertainment cost for business development is an administrative cost. It's a cost of growing your business, and that is an operating expense. So just to be clear with regard to cost of goods sold, those are actually very specific direct costs incurred to earn revenue. And I think the best way to look at it really is from a manufacturing standpoint, something tangible. So if you are, the traditional example is for accountants is widgets. So if you're making widgets, all the costs incurred in order to make that widget, so it's labor, materials, and even a portion of your utilities and other overhead, because obviously you would have a machine that's going to make that widget. That is a direct cost to sell the widget. If you're in a service-related business, much the way I am, when we sell our time, we generally would put those costs down in operating costs. So even though my time directly relates to the revenue that I generate, there's a significant portion of my time during the day that goes to, non-billable activities, and that's still important to the growth of the business. So that then comes back to travel and entertainment. It's important to the growth of the business. It's a very important piece. I think sometimes that can be overlooked when you're looking at cost-cutting measures, but it's definitely just an operational expense.
Okay, great. Thanks, Lynn. And Kath, another quick question here. How do you account for your tax remittances to the government? So you've got a GST number or you have a payroll tax number, and we know that those remittances can be on a different basis, requirement for remittance based on your volume of business. But if you can just explain how they would account for that tax so that they are ready when that payment has to be made, that would be great.
Well, I can tell you from a practical perspective, and maybe Lynn can answer the technical aspect, but from a practical perspective, if you know if you're collecting GST and you know you're going to need to make a GST payment on a quarterly or an annual basis, you're going to want to make sure that you are saving some of that from and have that cash in the bank in order to make those payments, because if they come up and it's a $5,000 or a $10,000 or a $50,000 payment, you're going to want to be able to make that payment.
From a GST perspective, I think that, I don't know that you'll hear many, you might hear many accountants say it is a good tax in that it's an end user tax. And so while you're collecting GST, you also are then reducing the amount collected by the amount that you're paying out. And so at the end of the day, you are collecting that tax for the government, and it isn't your cash to start off with, which is why they are very, very sticky. They call them trust funds, and CRA is very sticky about ensuring that they collect the GST. And their collection policy with regard to GST and payroll is very different than what it is for your corporate tax. So I'll just be brief, but essentially, one practical way to deal with it, and that I've seen in many clients, because they don't want the GST that they've collected to sit in their regular cash flow, is to have a separate bank account that they put their GST collected in. And that just keeps it separate from their regular operating cash, and therefore you know that it's there. As far as payroll, again, looking at your balance sheet, if you've recorded, yes, your CPP and EI payroll remittance amounts are expenses, and there's two sides to every entry. So it's an expense, and then the other side is a liability. And so looking at the liability side of your balance sheet and saying, what do I have to pay in the next month that is a liability, and do I have the cash available? That goes back to the cash flow planning that Kath was talking about, and I really believe using the Excel template that will be provided is a great way to be able to manage the expected payroll liability that would be in the next month against the cash that you have both on hand and that you anticipate to have come in the door. Now, from a corporate tax standpoint, that I would say that right now in British Columbia, it is going down, but the corporate tax is sitting at about between 12 and 13%. So if you go back to your income statement slide and you take your net income number, if you multiply that by 13%, then that is a great estimate of what you will potentially owe at the end of the year, and therefore you can include that as part of your cash flow planning for the coming year.
Hi, Kath. Did you want to add a comment to that as well?
No, but I'm happy to answer the question about the leadership grant and just grants in general.
Okay.
So there was a question here, are there any grants for small business owners that are legit? I applied for a leadership grant a couple of years ago and never got any response at all. So I just wanted to make a point about this in that, you know, for years and years I've been hearing about leadership grants, and I personally don't know of anybody that's ever been successful in getting a leadership grant. So just a heads up about that. We do have information on grants on our website, and so you can go to Women's Enterprise Center's website. We keep it up to date on information about grants. A grant, if you're planning on doing exporting, one grant that you might want to consider is the CAN Export Grant. It pays for 50% of your market development costs for a new market. I believe the Canada Jobs Grant is still available. There are some tech grants out there, and there's also the SR&ED, so the Scientific Research and Experimental Development Grant, or credit, basically. If you spend money on R&D, you may be able to get a portion of that back from the government. So those are just some things to keep in mind when you're looking at grants and credits.
Okay. And then one question here is, how often should I review my financial statements? And then why do my internal bookkeeper statements look different than my external accountant statement? So perhaps, Lynn, you can answer that one for us.
Absolutely. Often many bookkeepers record the transactions on a cash basis, and therefore they don't pick up the true picture necessarily of the position of your business at that point in time. And so if you purchased some inventory, if your year end is December 31st and you purchased some inventory on December 28th and received it, but didn't get a bill until January 15th, the bookkeeper would not have recorded that transaction likely at all. And so that would be an adjustment then as accountants that we would make, because that is a liability. One, it's an asset that you now have, and two, it is a liability as well that you have on a go-forward basis. The other is to go back to the wage example that I gave. You know, your employees have worked until December 31st, therefore you owe wages to December 31st. However, if you don't pay them until January 5th, because that's how your payroll schedule works, then often many bookkeepers would not have picked up the payroll. And so that's another regular year-end adjustment that we make. Many bookkeepers also do not record depreciation of your capital assets, and that would be another difference as well. Another area where you'll often see adjustments between the internal records that you have and the end product of the financial statements with your accountant would be in the investment side, such as the marketable securities. And so often, again, your bookkeeper or you, if you're doing the records, wouldn't have picked up any, possibly the interest on any GICs that you had invested in the year. And so those are really a lot of the main differences. And then as well, tax. Often the tax is not recorded, and so we would make sure that that is properly reflected. As far as reviewing your financial statements and how often that should happen, I believe that, you know, you could probably ask 10 different people and get 10 different answers, but I like to look at them really as they're a management tool and they're a measurement of your business. So if you are involved in your business, you need to be involved in your financial statements and looking at them regularly. Some are more important than others at different times. You know, the cash flow is very important. That's something that I would be looking at regularly, and by regularly, I would say, you know, once a month. The financial statements as a whole, it being the balance sheet, the income statement, you know, a quarterly review of them would be great. And that doesn't have to be with your external accountant. I can appreciate that cost can become a factor, but there's also value in that, maybe, you know, halfway through the year. But definitely your advisor at Women's Enterprise Center can help with that as well. looking at your income statement, again, would probably be something you would do monthly. Kath, I defer to you if you have any difference of opinion.
No, I completely agree that it depends on the type of business that you're running, but certainly reviewing your financial statements on a monthly basis and keeping up with reporting everything is really important. And some people, you know, they'll be reviewing their sales on a daily basis.
Okay.
Absolutely.
Thank you so much, Kath and Lynn. We've run out of time at this moment. We're at 11:01 already. Hard to believe. I think we could continue talking about this for quite a while. So just quickly, I've put a slide up there with all the resources that you can find here at Women's Enterprise Center. This has been recorded, this session, so it will be available on our website for reference as well. And we will send a follow-up email with the link to that recording, the answers to your questions. We will include some links to the grants and credits that Kath was mentioning. And also, for those of you that are interested, we are launching some financial fitness peer mentoring groups. And thank you to Lynn. She is going to be one of our mentors here in Kelowna for a group. So we have Mentee applications opening up next week for that. So if you are interested, if this piqued your interest and you would like to learn more, please visit our website, give us a call, and we would love to share that information with you because we all know how important financial literacy is to everyone in their business. So again, thank you to Kath and Lynn for joining us today as our expert panelists, and thank you to all of you participants for joining us. Enjoy the rest of your day, and we look forward to seeing you, hearing you, and discussing more topics with you on our next MAF, which will take place in May. Thanks, everyone. Have a great day.
Thanks, Carrie Lee. Take care, everyone.
Thanks, Carrie Lee.
Bye.
Bye.